Peter Rose, Longwood Currency Trading. It's early in March of 2021, and I've been asking some folks that have been asking me about trade entry and kind of what I do in relationship to the short stop that I take. So that's kind of what I want to cover today. But first, I got to go get some cream for my coffee. Come on with me, we'll get that done. All right, coffee is ready, but it needs some cream. That's that part of it. All right, let's head off into the library. The sun is out really bright today. It's been cold at night, but today we've got the sun out and it's supposed to be in the 40s, so that should be pretty good. But as you can see in the library here, the sun is kind of really coming in through the window, so I'm going to sit down over here and talk with you for a few minutes. All right, so sitting down in the library after closing some of the blinds so the sun isn't too bright, and it's going to swing around and hit me pretty soon, so I'll have to make this short. Trade entry is a really complex issue, as you've traded before, and you know. I mean, I'm not really speaking that much to beginner traders, and so you've all had experience, and you know what a bitch doing trade entry is. Because if you don't get that right, your stop's going to get hit, and if you don't have a good win-to-loss ratio, you're screwed. Okay, so there are a lot of factors in trade entry. One of the generic ones is simply making the statement is, does the price action, the current price action, have enough energy, or we're going to call that momentum, or other people might call it volatility, velocity, or from a physics standpoint, we'll talk in terms of momentum. And by the way, I'm going to leave in the notes for this video a couple of references to other videos where I talk about this particular kind of issue of momentum, or at least in the trade entry standpoint of things, in a little bit more detail than some of the generic stuff that I've done in the past. But this specifically looks at that momentum factor and how to kind of look at the connection between the trade entry and that momentum, because you can use momentum for a lot of different things within the trade management spectrum that you have to deal with as well. But the whole key to trade entry is, does price have enough momentum to get to where your profit target is? At first, you have to be astute enough to recognize a valid profit target and that it should be within the scope of the main price direction, the trend, let's say. It's very hard to use what I'm going to talk about today when you're in a chop. There's other techniques that you use. This tends to be more of a trend-oriented trade entry methodology, is to look at the momentum, because when you're in a chop, you don't have time for the momentum. You're looking for strict levels and bounce and stuff like that. And if you're a long-term trader, you're not interested in the chop. You don't trade in the chop. You trade for the long term. You're in it for days or weeks at a time, and you need that momentum. You're not going to survive as a long-term trader in the chop. You just aren't. And that's why I say that the techniques that a short-term or day trader will use are mappable into the longer-term trading aspects, but the longer-term traders can't directly map their stuff down into the day trading, because you get a tremendous amount of chop in the day trading, because you're looking at, let's say, a 5-minute chart. You get trending about 30% of the time. So in a longer term trend that could be several weeks, and that's 30% of some, you know, longer period of weeks. But on a because the price action is fractal, you get the same 30% even in a chop on a day for day trading. So you just have to look at what price action is currently doing and what that chop represents. But you're still using the momentum of, let's say you're trading long term, you're looking at the momentum of that upswing in order to pick your entry points and your exit points. So you're not really looking for an entry point when you go in for trade entry. You're simply looking at where is the price right now and what's the directional bias, the long-term directional bias. And I'm talking in terms of a day trader again. So I'm looking at structuring my trade around the 15-minute chart, and I'm actually going to place the trades, the limit orders, or my mental areas of working down on the 5-minute chart. I'll trade on that 5-minute chart. But I look for the trend bias up on the 4-hour or the daily. I don't want to look out on the weekly chart because there's just so much stuff going on, even on the 4-hour chart that counters whatever's going on in the weekly. It's just silly. And again, if you're trading, if you're a day trader, there's really no need to look at the hourly chart. If you're going to make a series of day trades, or you're going to be day trading over a, you know, that's what you're going to do over a long period of time, you need to take a look at that daily chart. What's the momentum of that daily chart? Is that rising? Let's say that is rising. But if I'm just going to trade today, does that mean that what happened over a period of 24 hours times 50 candles over that number of hours, does that really have any relevance to what could happen on a daily basis? I'm concerned with getting in and being out of the trade, hopefully within a half an hour, maybe a couple hours. If the thing is running well in my favor, yeah, I may want to stick with that. I mean, I'm only shooting for 25, 30 pips. So you could get that easily in a couple of hours. If the thing is going to go on, if you're in a breakout situation or something like that, you may want to ride with that for 4 hours or whatever however long you can stand to sit there and watch the thing. But the key is the trade entry, not the management of it. That's not what we're talking about. But the trade entry. When do you go in? When's it good to go in? And that comes into, does the price appear to be having the lift to it in order to get it probabilistically moving toward that profit target that you have? So we use a term, in physics we use the term momentum. Momentum is the mass of something times how fast it's moving. The velocity, mass times velocity, is the momentum. So obviously the faster something moves, the more velocity that mass is going, the more momentum that mass is going to have. It's like a car that's not accelerating, it's just moving at 30 miles an hour, and you compare that to a car that's moving at 50 miles an hour, not accelerating, but constant rate of speed. If you look at change in acceleration, or change in velocity, which is acceleration, the time rate of change of the velocity is the acceleration, now you're looking at a force, not a momentum. And you don't want to be looking at forces in currency trading when you're looking at momentum, which is a constant velocity times the mass. So obviously a car moving at 60 miles an hour is going to have more momentum than a car moving at 30 miles an hour. The resistance of the road may slow a car moving at 5 miles an hour down. The resistance may just slow it down. It may not move at all. But if that car is moving at 30 miles an hour, it's got that momentum that if all of a sudden you pull the ignition out of it and whatever, it's going to have more oomph to get it to move further than if you pulled the keys out of the ignition if you were only going at 5 miles an hour. Got that? So that's the momentum that we're talking about. So does the momentum, is the momentum there? In other words, if in currency trading, the momentum is going to change that price action radically right away. It doesn't have that residual type movement. You're constantly, in currencies, you constantly have to add orders, which is the mass in currency trading. You constantly have to be putting orders in order for there to be any kind of a velocity to that process. The more orders that come in per unit time, the greater the velocity. So you've got the mass, which is an order, and you get the number of orders being placed per unit time, which is the velocity component that's going to provide you that momentum. So if all of a sudden everybody said, I'm not gonna buy anymore, well, the price immediately drops. You don't have this ongoing thing. Well, everybody doesn't go for the exit door at the same time. From a day trading standpoint, if you're looking on a 5-minute chart, you start seeing the weakness in that momentum. Well, how do you judge them? How do you judge it? Well, it's going to be by the candle size, right? And this is where the ATR comes in. Let's say you're on a 5-minute chart with a 5 pip ATR. What that means is that the average distance of a candle, the average size of the candle between the high and the low, over the past 14 periods is 5 pips. But you got to remember, that's an average. Averages travel in ranges. So that range might be, I don't know, 7 pips to 4 pips. So prices bouncing around between 7 pips and 4 pips in a range over 14 periods, and that averages out to 5 pips. Okay? That's how you get the ATR. Well, it's much more complex than that, but let's just wave our arms and keep it simple. We had a 5-minute chart, 5-period ATR, or 5 pip ATR, and all of a sudden you see a candle that's a 5-minute candle that's 10 pips. Well, that's something you may want to look at, because what does that mean? What does the different size mean? You've got an average of 5, and all of a sudden you've got double that. You've got a 10 pip candle. That means that you've got more orders coming in and moving the price, and because the orders are coming in very fast, it means that those orders are collected within that one 5-minute bar. That's what makes it 10 bars, or 10 pips. If the orders were coming in slowly and being splattered over 4 or 5 of those 5-minute candles, you wouldn't see a 10 pip candle. You'd see an average of 5. That's how it's all done. All right? So that one 5-minute bar becomes 10 pips. You go, whoa, something might be going on here. If the second bar continues on from the close of the previous 10-bar candle, and it continues to go up 5 pips, which is the average, that's a really good sign that now you've got momentum going into the market at that point, that you have a tremendous amount of interest. So from wherever you started looking at this thing, we've gone at least 15 pips, 3 times the ATR. So now you say, well, I've got some momentum in price right now. If you were looking before that and you didn't see that bar, you wouldn't be looking at a trade. You'd just be looking at the price, waiting for this particular momentum event to signal that price is on the move. Now you've got momentum. Okay. That momentum could be a rush of orders that goes to some structural level that's a resistance point. You would not want to enter a trade because of that. Because what causes a resistance level? It's a collection of orders that have been terminated at that point for whatever reason. Don't want to buy anymore. You'd have to wait and see if the momentum of that candle causes a breakout. This is where breakout theory comes into play. And you would then have to ask yourself, because in currency trading, probably, I don't know, 80 or 90% of the breakouts retrace back into below that resistance level. And there are reasons, economic reasons, why that happens. But if you just trade the breakout, oh, I've got a breakout, my candle closed above the resistance, you're fucked. Yeah, I'm sorry, but that's just not, you're going to have to get some education in your trading. Regardless of the fact that I'm not teaching trade opening theory, I'm teaching when to recognize that momentum may have a significant sign that you have a trade entry possibility. Well, again, if price is moving momentum-wise close to that resistance level, that's not an indication that you want to trade. So there might be other things that you want to be on the lookout for. Perhaps you'll be ready to put a trade that's the reverse of where that momentum is going. You would say that the momentum is creating an exhaustion in the price, and it may be ready for a reversal at that point. But the important thing is, have you recognized that price action has changed over the mean? That's the thing that you're trying to recognize for any kind of a trade entry that you're going to go into. In the event that you're not well versed yet in past structural theory or the concept of levels, you probably ought to study that stuff, because just trading off of levels or just trading off of structure or just trading off of momentum doesn't work. And that's the problem, I think, with a lot of beginner traders. They pick up something that some guy is saying, oh, I use this and this is how I do it. You have to take a course from them in order to understand how all these pieces fit together. I mean, I could look at somebody baking a cake and they say, well, I just mix the batter and put the flour in and it's ready to go, and an egg. And well, what? There's an order of ingredients that need to go into that cake. There's timing involved. There's stages of that, and you have to be aware of all those pieces in order to understand the importance of how they all fit together to make the cake. You can't just make the cake and put it into the oven and then turn the oven on. You have to know that the oven is hot when you start making the cake, because if you don't get it in the oven, it's going to cook right. Okay? So it's no different. You just look at the things in nature that are around you that give you common sense. I mean, spending 50 years in the martial arts and all the philosophical ramifications of how things work in life, and correlating that with my degree in physics and understanding the mathematics involved with all this stuff, it all makes great sense. But if you don't understand that stuff, find somebody who does, who can dumb it down for you, make it simple, and show you how pieces fit together. That's what recipes are for on the back of a cake box. And even if you're experienced, you're still looking at that recipe to make sure that particular brand of flour or that particular mix that you're going to use requires the same steps. Some cakes may take X amount of time to bake. Others may take a shorter time to bake. I was just fixing a bechamel sauce last night for dinner. We had chicken and bechamel sauce. Bechamel, I guess, is how you pronounce it, with skillet sautéed asparagus. And depending on how much of that bechamel that I would use, was there was a proportion between the flour and the oil and the milk and all the other stuff that that goes into that. And if you don't get it right, it doesn't taste the same as maybe an experienced chef would be. I'm not a chef, I just cook. I can throw things together, but I don't do sauces like that very often, and so I had to look at the recipe. And I was making more food than the original recipe that I had, that I got from a chef, by the way, not out of a book or anything. And it was per serving, and so I had to multiply that out, and so I didn't get the end result as good as it should have been, because in this type of cooking it's not linear. If it says you need 1.5 cups of milk for X amount of flour for 2 servings, that doesn't mean that you double it if you go to 4 servings, because you don't get the same consistencies. And so trading is very much the same way. You can't take what I would say, like, oh, I'm trading on a 5-minute chart and it's got a 5-period ATR and I've got a hard 8-pip stop. Well, you can't trade that way and make it work, because that's not all I'm thinking about in my trading. The 8-pip hard stop has to be set in relationship to the profit target. It has to be taken into consideration of the current ATR, not the theoretical ATR that I talk about all the time in my videos. And so a lot of people will say, oh, 8-pip stop is too short, it's too blah, 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 blah. Well, an 8-pip stop isn't too short if I'm dealing with a 3-period ATR, right? It's not, because my profit target isn't going to be 30 pips. Things have to change. So all you can do is give a recipe as guidance. If you really want to learn how to trade, you're either going to have to make a lot of trades and make a lot of mistakes and track your results, or you got to go to somebody who can work with you and show you how to manage the ingredient levels that you're putting into your trade in order to make this stuff work. For me to talk about momentum and having a 5-pip ATR, and when it goes to 10 pips, that's a signal that you might want to look at, is theoretical. It has nothing to do with the real world. It's not what I do. I don't measure it like that. I just look at it. Oh, gee, I've got a weirdo candle here that popped up. I wonder if that's going to be reproducible. I'm not going to wait another 10 pips because I've already covered my 20-pip distance by that time to my profit target. So you can't just take these things out of context and try to apply them into your own trading when you're listening to those of us that are trying to help you through these videos. Because a lot of it, and I've done quite a few other videos on our personality, has to dictate the rules that we use as to how we approach our trading. And that gets down to whether you're going to be a day trader or whether you're going to be a longer term trader or a swing trader maybe. So there's certain steps that you have to go through in looking at your trading, and you can do this by reading hundreds of books and watching thousands of videos, but there's so much noise out there that you won't find the relative pieces of information unless you're specifically educationally trained to be able to do that. And even me, with a 33-year career as a senior software engineer doing business applications and being able to look at complex business problems and being able to say, okay, these issues are all related together, this forms a unit of work, and these issues are related together, and this forms a unit of work, and then I got to figure out how to hook those 2 units of work together. Well, we're trying to do the same thing in trading. We have all these rules, but the rules have to be put into a certain order. I've said many times that if you have 5 rules, just 5 rules, or indicators that you use, you have over 300 different permutations that you can put those rules in, with just 5 of them. I mean, that's just a shithouse full of complexity. You know, so you need to simplify this stuff. And so if you're out there reading all these books and looking at all these videos and you say, oh, I think Al Brooks has got the whole thing, or I think Rob Booker or Peter Rose, or they've got the nuts, and I'm going to follow them on videos and I'm going to read their books or whatever, you're still not going to be able to replicate it because you don't have that same personality. And so you need to sit down with whoever that person is, or you need to really just take a full study of that person's body of work in order to figure out how they think and how they consider, what their appetite for risk is, and how their whole principles of trading are, in order for you to look at that and develop what your principles of trading are. Emerson, in his essay on self-reliance, said to the effect that you need to know what Aristotle said and you need to know what Plato said, but in the end result, it's what you have to say that's important. But the caveat that he's laying there is you need to know what these guys all said. Oops, there goes my notes. You need to know what these guys all said in order to come to a conclusion as to what you should say, abstracting out the things that speak to you from all these different sources so that you can come to the conclusion on how you want to deal with that. Plato talks in his ethics, his essays on ethics, about freedom and balance with responsibility. You're free to do anything you want as long as it doesn't adversely impact other people, it doesn't infringe on their rights, and it's not bad for you. You're free to drink alcohol, but it would be irresponsible of you to over drink alcohol. That's what Plato is saying. You have freedoms, but you also have responsibilities. So you have the freedom in currency trading to pick any kind of system that you want, or to conjure up some shit in your mind about what you think that, you know, a Bollinger Band should be used for or whatever, and you can go out and you can try that. But it won't work. And so what'll happen is you'll go, oh, well, that didn't work, I'll try something else. Where instead what you should do is what Jesse Livermore suggests. Invest your cash, track your trades, and study from your mistakes. And so if you've got this fantasy that the Bollinger Band is the secret to all of life, trade the Bollinger Band. And you're going to lose. And you're going to lose and lose and lose and lose and lose until you figure out, oh, you know what? I should have looked at this component, or I should have looked at the momentum, or I should have used this, or it makes sense for me to use this component of the thing. And I'm going to combine that with how I look at the Bollinger Band. And all of a sudden your win-to-loss ratio goes from winning 1 in 10 to maybe winning 3 in 10. Now you're on your way. Now you just refine that. That's why there are an infinite number of ways of trading. So you can't look at that stuff. You have to be able to look at the available methodologies, select the pieces that you like. Don't pay any attention to whether they work or not. Select what you like, what appeals to your personality. My personality is very action-oriented. I want to see something and I'm going to act on it. If you come up after 50 years in martial arts, if you come up to me and say, I'm going to punch you in your face, and you stick your finger in my face, you're in the fucking dirt, pal. I'm not going to wait for you to punch me in my face. You know, I'm used to action. You take action. You can't sit there and go, oh, well, I wonder if blah, 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 blah. You can't have that indecision. You have to have rules. Well, the rules that I have are over a lifetime of studying philosophy, studying trading, real estate investment, computer programming, all this stuff that I've done. I'm able and know how to pick out not only the rules that should be generic for everybody, but how to phrase that rule so it meets my specific personality and criteria. So that when I lose, I know exactly why I lose. And I've just talked recently in the last video or a couple of videos ago about still making mistakes because of my tendency to let a price run against me. And I'm not doing that because I'm stupid. I'm doing it because I have all this engineering background, and so I'm constantly looking for fractal solutions of all this stuff. And I can't convince myself that that doesn't work in the way that I'm applying it in the currency trading. It's not applicable. It needs to be the rule needs to change and be phrased differently. But the rules, guys, can't be phrased as these are rules to prevent you from doing something. The rule can't just say don't do that, because that's counter to your personality or your intuitiveness that wants you to do that. When somebody says don't touch that, it's wet paint, what are you going to do? The guy's telling you it's wet paint. What are most people going to do? They're going to go over, they're going to touch it. Oh yeah, that's wet. Oh man, and you're going to continue to do that. So instead, you need some other incentive not to touch the wet paint. That's a positive thing. We tend to make our trade management rules against something instead of for something. That's something that I work with if I have somebody that's a student of mine, to try to get them, because I've said constantly that our intuition, the way we think things should be and we think things should go based on the evidence in front of us, is not how we react to those things. In currency trading, it's counter to a lot of the intuitiveness that we have, and that's very difficult because of our personalities. And so when I talk about this momentum stuff, I'm just giving you a baseline of be aware of the momentum and the ATR. Well, the differential between the candle size and the ATR, is that an ATR on that particular time frame? Is it on a lower time frame? Is it on a higher time frame? What's that percentage difference between the candle size and the ATR that you're looking at as a percentage? When should that candle be not just a little bit over maybe the high of the range, but perhaps a certain percentage over that in order to count that? I mean, what's that differential? I mean, there's all these shades that we talk about in the momentum. Do I know what those things are? Sure. Am I going to tell you what they are? No, because it doesn't make any sense. It's not going to help you. That's not part of it. I could say that on my in this particular instance, I've got a 5 pip ATR with a range of 7 to 4, and based on the other structures and the other stuff that I'm seeing around here, a 10 pip candle to me would be indicative of something that I should look at. That could be a 9 pip candle. It could be an 8 pip candle. It could be something that is a 7 pip candle that goes from the top of the last candle upward, as opposed to a 7 pip candle that is buried within some of that range binding. Those are all things that are situation dependent, and so I'm going to put up a slide here. Look at the next page here. I put up a slide here of a rough drawing of what I've been talking about here, and you can see it's a 5-minute chart, ATR of 5. The range is 7 to 4 pips. I've got a large pip there, candle. You can see I write that's of interest. Well, yeah, that's of it. In that particular scenario, that candle would be of interest. And look at the next candle. It doesn't go from the top, but it's of real interest because it is and has the appearance of being larger. It's not 10 pips like that one. It may be 5 or 6 pips, but it's a position there. I mean, you don't have to be a rocket scientist to look at that and say, hey, that looks like something that's changing. I've got a lot of orders coming in here that's changing price. Does that have the momentum to go further? And that's the only question that you need to ask yourself. So enough of that slide. I guess the takeaway here is that I'm using the equation for momentum from physics and applying it into the currency market. And you could say, well, you could do that because you're an engineer and blah, 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 but that makes no fucking sense to me at all as a liberal arts person. I'm a potterer that's trying to learn currency trading, so you talking about momentum is just stupid shit. And it is. It's not useful. It might be, if you're in the audience, I would say maybe 5% of the folks that are going to listen to this particular video, maybe 10%, may be technically oriented and know what momentum is, and probably even a lesser percentage would know the difference between momentum and force. Okay? So what am I doing? Talking to some dead black cat? No. What I'm expressing to you is the need to understand price momentum is manifest by a larger candle than the other candles that are in the range that are there. That you should take note of that. That might mean something. What does that mean? It just doesn't mean you've got a bigger fucking candle. It means that you have more orders per unit time coming into the market. What's the reason for that? And is that reason sufficient to have that continue? Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day.